Do you know that in the 1630s, people sold their homes to buy flowers? That a single tulip bulb sold for more than a skilled craftsman could earn in 10 years? And that when the market collapsed, it happened in a matter of days, leaving nothing behind but the template for every financial bubble that followed? This is the story of Tulip Mania, the world's first recorded speculative bubble, and the lesson no generation has ever managed to learn from it. This video is for educational and informational purposes only and does not constitute financial advice. Chapter 1. The flower. The tulip is not native to the Netherlands. This seems important to establish at the beginning because the story of Tulip Mania is partly the story of how a foreign object, introduced into a specific social context, can acquire a symbolic value far beyond anything inherent in its nature. The tulip originated in Central Asia, in the mountain meadows of Anatolia, Persia, and Central Asia, where it grew wild and had been cultivated for centuries. The Ottoman Empire had a particular relationship with the flower. Sultans maintained elaborate tulip gardens, and the flower appears extensively in Ottoman decorative art. The word tulip derives from the Turkish word for turban, suggesting that the flower's shape was what struck early observers. The flower reached Europe in the mid-16th century, brought by traders and diplomats. The botanist Carolus Clusius brought tulips to the Netherlands in the 1590s when he was appointed head of the botanical garden at the University of Leiden. He was protective of his collection, refusing to share bulbs, which led to theft. The stolen bulbs became the foundation of the Dutch tulip industry. The Dutch Golden Age, the 17th century, was one of the most remarkable periods in European history. The Dutch Republic was the world's leading commercial power. Amsterdam was the world's financial center. The Dutch East India Company was the largest corporation that had ever existed. The Dutch merchant class had accumulated extraordinary wealth through trade, and that wealth needed somewhere to go. It went, among other places, into flowers. Chapter 2. The Golden Age. To understand Tulip Mania, you need to understand the Netherlands in the first third of the 17th century. This was a society that had recently won its independence from Spain after a war lasting 80 years. It was a Protestant republic in a world of Catholic monarchies. It was governed by merchants rather than aristocrats. It had developed, almost by necessity, the most sophisticated financial system in the world. Joint stock companies, futures markets, insurance markets, foreign exchange instruments. The Dutch financial system was not merely a collection of institutions, it was a culture. Amsterdam in the 1630s was a city in which financial sophistication was expected of ordinary citizens to a degree unmatched elsewhere in Europe. People who would in other countries have remained entirely outside the financial system, artisans, farmers, small traders, were in the Netherlands accustomed to using financial instruments, to thinking in terms of risk and return, and to participating in markets. This financial sophistication was, paradoxically, part of what made Tulip Mania possible. A population unaccustomed to financial markets cannot participate in speculative bubbles. A population that is deeply accustomed to financial instruments, that thinks naturally in terms of buying and selling contracts, of future values and present prices, can extend those instruments to almost any underlying asset, including flowers. The Dutch also had a particular aesthetic relationship to luxury goods. The wealth accumulated in the Golden Age was expressed partly in consumption, in the paintings of Rembrandt and Vermeer, in the elaborate domestic interiors that those paintings depict, in the furniture, the porcelain, and the decorative objects that filled the merchant houses of Amsterdam. Flowers were part of this world. The Dutch flower painters, the genre was invented in the Netherlands, recorded elaborate arrangements that were themselves symbols of wealth. Into this context, the tulip arrived as something genuinely extraordinary. Chapter 3. The flower's peculiarities. The tulip was, by the standards of other luxury goods, unusual in several ways that were important to the dynamics of the speculation. First, it was a living thing. Unlike a painting or a piece of silver, a tulip bulb was perishable in some senses and also self-reproducing. A tulip plant produces offspring bulbs over its life. An investment in tulip bulbs was an investment in something that could, in principle, produce returns through reproduction. One bulb becoming two, two becoming four, generating a kind of compound growth. Second, and more important to the specific dynamics of the 1630s bubble, some tulips had a peculiarity that made them extraordinarily valuable. Certain tulips displayed what was called broken coloration, dramatic patterns of flames and streaks in their petals, combinations of colors that no breeders had been able to reliably produce or predict. The Semper Augustus, the most famous and most expensive tulip of the period, displayed red and white flames on its petals that made it one of the most visually striking flowers ever bred. What caused the breaking was not understood in the 17th century. It was later established to be a virus, the mosaic virus, transmitted by aphids. The infected plants were beautiful, but also sickly. The breaking coloration was a symptom of disease, and infected plants were less vigorous and less productive of offspring than healthy plants. The most valuable tulips were, at the molecular level, diseased. This created a peculiar market situation. The supply of the most desirable tulip varieties was inherently limited and unpredictable. No one could simply breed more Semper Augustus bulbs at will. The virus and its effects were beyond human control. The combination of extreme desirability and constrained supply produced the price dynamics that would characterize the peak of the mania. Chapter 4. The market develops. The tulip trade in the Netherlands developed gradually through the 1620s and early 1630s. Initially, it was a trade among wealthy collectors, members of the merchant elite who grew tulips as a hobby and a status symbol, and who traded bulbs among themselves at prices that were high by the standards of ordinary goods, but not wildly speculative. During this period, the trade had a seasonal character. Tulip bulbs are in the ground from planting in autumn to lifting in summer. Buyers and sellers could examine actual bulbs at certain times of year, observe the flowers they produced in spring, and make reasonably informed assessments of what they were buying. The introduction of futures contracts changed this. As the tulip trade grew in scale and value, traders began dealing in contracts for bulbs that were still in the ground, agreeing to buy and sell specific varieties at specific prices to be delivered at the next lifting season. This extension of the Dutch futures market to tulip bulbs had consequences that were not fully anticipated. It meant that someone who did not have the capital to buy an actual tulip bulb could buy a contract for one. It meant that buyers and sellers did not need to examine or possess the actual commodity. They were trading pieces of paper that represented promises about future delivery. It meant that the market could expand far beyond the circle of wealthy collectors who had originally been its participants, drawing in anyone who could fund a modest contract deposit. The taverns of Haarlem, the city that was the center of the Dutch flower industry, became the trading venues for tulip contracts. Ordinary people, including weavers, bricklayers, carpenters, and other craftsmen, began participating in the market. They funded their entries through savings, through loans, sometimes through the sale of household goods or property. This was the key demographic shift. The tulip market had moved from wealthy collectors to ordinary people with limited assets, limited financial sophistication, and, crucially, limited capacity to absorb losses. Chapter 5. The Peak. The peak of the tulip speculation occurred in the winter of 1636-1637. The prices of the most desirable varieties reached levels that were, by the standards of any rational assessment of what a flower bulb was worth, completely extraordinary. The Semper Augustus was reported at prices that varied between 3,000 and 10,000 guilders per bulb, depending on the account. To put this in context, the average skilled craftsman in Amsterdam earned around 250 guilders per year. A single Semper Augustus bulb at peak prices would have taken a skilled craftsman between 12 and 40 years to earn. A house in Amsterdam could be purchased for the price of the most sought-after bulbs. Even the common varieties showed dramatic price increases. Bulbs that had been traded at a few guilders in the early 1630s were commanding hundreds of guilders at the peak. The percentage increases were extraordinary, not double or triple, but tenfold, 20-fold, 100-fold. Why did prices rise to these levels? The same mechanisms that drive all asset price bubbles apply here. Rising prices attracted new buyers, who drove prices higher, which attracted more buyers. The people who had entered the market earlier made profits on paper. Their contracts showed values many times what they had paid. And these paper profits were visible and discussed and invited imitation. The social proof mechanism operated at full strength. Everyone else seemed to be making money, so the person who was not participating was the one who looked foolish. The Dutch financial infrastructure that made sophisticated market participation possible for ordinary people also made it possible for ordinary people to participate in a speculative frenzy without the savings or assets to absorb the inevitable correction. Chapter 6. The Collapse. The tulip market collapsed in February 1637. The precise trigger is, typically for financial bubbles, somewhat unclear in historical accounts. What is clear is that at a regularly scheduled bulb auction in Haarlem in early February, buyers failed to appear. Contracts that should have found buyers at the expected prices could not be sold at any price. Once word spread that buyers were not materializing at the anticipated prices, the dynamic reversed with the same speed it had escalated. Everyone who held contracts needed to sell before prices fell further. Everyone who might buy knew that everyone who held contracts needed to sell. The bid dropped. Then the bid dropped again. The futures contracts that had inflated the market, the promises to buy at future dates at specified prices, now became liabilities. Sellers who had agreed to deliver bulbs at high prices were owed money by buyers who either refused to honor the contracts or could not pay. Buyers who had promised to pay high prices were now facing demands for payment on contracts whose underlying assets were worth a small fraction of the promised amount. The Dutch government attempted to address the crisis. Local authorities tried to mediate between buyers and sellers. The courts were asked to determine whether contracts could be voided. The ultimate resolution, arrived at over the following months, was that futures contracts entered into at the peak of the bubble could be voided by buyers paying a small fraction of the contract price. This arrangement protected the most leveraged buyers from complete ruin at the cost of leaving sellers with returns far below what they had anticipated. The physical bulbs, of course, still existed. The Semper Augustus still grew. The flowers still bloomed in spring. But what they were worth, what someone would pay for them in a market that had just discovered that all the prices had been fictional, was a fraction of what they had commanded at the peak. Chapter 7. The Casualties. Who lost money in Tulip Mania? This question is more complicated than it might appear, and the work of historian Goldgar has significantly revised the popular understanding of the event's economic consequences. The popular account of Tulip Mania, largely derived from Charles Mackay's 1841 work, Extraordinary Popular Delusions and the Madness of Crowds, describes a society-wide catastrophe in which people from all walks of life, including sailors and servants, sold their homes and possessions to buy tulip contracts and were ruined when the market collapsed. Goldgar's research in Dutch archives produced a more nuanced picture. She found that the tulip trade, while genuinely extraordinary in its price dynamics, was not as widely participated in as the popular accounts suggested. The number of people directly involved in tulip futures trading was relatively small, probably in the hundreds rather than the tens of thousands. The catastrophic stories of ruination, families forced out of homes, fortunes entirely destroyed, are largely absent from the contemporary documentary record. What Goldgar found instead was that Tulip Mania's most serious consequence was social rather than purely financial. The episode broke trust between buyers and sellers in ways that were difficult to repair. The refusal of buyers to honor their contracts, even at the reduced settlement amounts arranged by local authorities, damaged commercial relationships and reputations in a merchant society where reputation was a form of capital. The participants who were most severely damaged were not the wealthy collectors who had been in the market from the beginning, but the new entrants who had joined at or near the peak, funded by savings or loans, with no cushion against loss. For them, the collapse of the futures contracts was a genuine financial blow, even if it was not the society-wide catastrophe of later legend. Chapter 8. Charles Mackay and the Legend. Most of what the modern world knows about Tulip Mania comes from a book that was written 200 years after the events it describes. Charles Mackay was a Scottish journalist and poet who published extraordinary popular Delusions and the Madness of Crowds in 1841. The book surveyed what Mackay considered the most spectacular examples of collective human irrationality in history, including the South Sea Bubble, the Mississippi Scheme, the Crusades, and Tulip Mania. Mackay's account of Tulip Mania was vivid, dramatic, and detailed. It described prices that seemed impossible, behaviours that seemed insane, and a collapse that seemed total. It identified specific individuals and specific transactions. It provided the anecdotes: the sailor who ate a tulip bulb believing it to be an onion, the nobleman who sold his estate for a single Semper Augustus, that subsequent accounts have repeated. The problem is that many of these details cannot be verified in contemporary Dutch sources. Goldgar's archival research found no evidence for some of Mackay's most dramatic claims. The extent of participation, the scale of losses, and some of the specific anecdotes appear to have been exaggerated or invented by the later pamphlet literature that Mackay relied on. Literature that was itself moralizing and propagandistic rather than journalistic. This does not mean Tulip Mania did not happen. It did. The price movements are documented. The futures trading is documented. The collapse is documented. What is not fully supported is the scale of social disruption and the specific stories of individual ruination that have given the legend its power. The legend matters, however, because it is through Mackay's account that Tulip Mania entered the vocabulary of financial crisis. Every subsequent bubble has been compared to the tulips. Every discussion of speculative excess references the flowers. The legend shaped how subsequent generations thought about market psychology, even if the legend was partly a creation rather than a pure record. Chapter 9. The Pattern in History. Tulip Mania established what might be called the template of the speculative bubble, a pattern that has been repeated with variations in every subsequent major speculative episode. The pattern has several consistent elements. The first is the genuinely valuable underlying asset. Tulips were real flowers of genuine beauty. The desirable varieties were genuinely scarce. The aesthetic pleasure they provided was real. The underlying asset had real value, just not the value attributed to it at the peak. This is important because bubbles are not generally built on pure fictions. They are built on exaggerations of real values. The Dutch investors were not simply making up the desirability of tulips. They were correct that tulips were beautiful, that they were fashionable, and that they were status symbols in a society that cared about such things. They were wrong about the degree to which that desirability translated into durable economic value. The second element is the financial innovation that extends participation beyond the natural market. In 1637, it was futures contracts that allowed people without the capital to buy actual bulbs to participate in the market for them. In later bubbles, it has been margin loans, mortgage-backed securities, and various other instruments that allow more people to participate in markets than could participate if they needed to fund their positions directly from their own savings. The third element is the social proof dynamic. Rising prices attract new participants who drive prices higher, which attracts more participants. The person who is not participating looks, for a period, like they are missing out. The social pressure to participate is real and documented in every major bubble. The fourth element is the leverage that amplifies both the gains and the ultimate losses. Participants who funded their positions through loans or contracts rather than through their own savings are exposed to losses greater than their initial investment when prices fall. The fifth element is the speed and completeness of the reversal. Bubbles do not deflate gradually, they collapse. The mechanism that inflated them, the social proof of rising prices attracting new buyers, reverses. The social proof of falling prices drives sellers and deters buyers. The same psychology that drove prices up drives them down. Chapter 10. The Semper Augustus question. The Semper Augustus deserves particular attention because it illustrates something about the nature of value that is relevant well beyond the specifics of 17th century Dutch flower markets. The Semper Augustus was beautiful. By the standards of what existed in the 1630s, before modern breeding and colour selection had produced the enormous variety of flowers available today. Its dramatic red and white flaming pattern was genuinely extraordinary. Nothing like it had been widely available before. The scarcity of the virus-induced breaking meant that reproducing its appearance reliably was impossible with the knowledge available. So when someone paid a vast sum for a Semper Augustus bulb, they were not simply succumbing to irrational exuberance. They were paying for something that was genuinely rare and genuinely beautiful. What they were wrong about was the persistence of that scarcity, the assumption that the combination of beauty and rarity would continue to command high prices indefinitely. The Semper Augustus was worth a lot when almost no one had it. Once the virus spread further, as viruses do, and once more plants with similar coloration became available, the specific scarcity premium disappeared. The flower was still beautiful. The premium for its particular rarity could not be sustained. This is a pattern that repeats in subsequent bubbles. The most valuable internet company in 1999 might have a genuine business model and genuine revenues. What it did not have was a defensible reason to be worth 500 times its annual earnings. The genuine business value and the speculative price overlay are not the same thing, but in the middle of a bubble, they look like they might be. Chapter 11. What the Netherlands learned. The Netherlands, in the aftermath of Tulip Mania, did not collapse economically. The Golden Age continued. The Dutch East India Company continued to be the world's largest corporation. Amsterdam remained the world's financial capital. This is an important corrective to the legend of Tulip Mania as a civilizational catastrophe. The Dutch economy in the 1630s was not primarily a tulip economy. The tulip bubble was a speculative episode that affected a relatively small portion of the population. Its collapse was painful for those who had participated and lost, but it did not bring down the broader Dutch economic system. What it did was produce a change in how Dutch law and commercial practice treated futures contracts for perishable goods. The Dutch government's response, allowing buyers to void contracts by paying a small percentage of the contract price, effectively treated tulip futures as options rather than firm commitments. This legal resolution was not codified into formal law, but it established precedents about how these kinds of contracts would be treated in the future. The Dutch financial system also developed, in the wake of the episode, a somewhat greater skepticism about commodity futures markets. Not enough skepticism to prevent future speculative episodes, but some. The system survived and continued to evolve. Chapter 12. Subsequent history of the bulb. The Dutch flower industry survived Tulip Mania and is still flourishing today. The Netherlands remains the world's leading producer of cut flowers and flower bulbs, exporting billions of bulbs and flowers annually. Tulips are among the most widely grown ornamental flowers in the world. They are planted in parks, gardens, and window boxes in almost every country. The Keukenhof Garden near Lisse in the Netherlands displays millions of tulip bulbs each spring and attracts more than 1 million visitors. The Dutch flower auctions at Aalsmeer handle billions of flowers every year. The Semper Augustus no longer exists. The virus that produced its famous coloration has been eradicated from commercial breeding stock because it reduces the vigor and productivity of infected plants. You can see paintings of the Semper Augustus. 17th century Dutch still life painters recorded it, and the paintings survive. But you cannot see the actual flower that once sold for enough money to buy a house. The flower that drove people to sell their homes, that became the most expensive object of its kind that had ever been bought and sold, exists now only as a pigment pattern in oil paint hanging in museums. Chapter 13. Why Tulip Mania Still Matters. The Tulip Mania of 1637 happened almost 400 years ago. Why does it still matter? It matters because its structure, the pattern of asset appreciation driven by social proof, leverage, and the suspension of rational price assessment, has been reproduced in every major speculative episode since. The Mississippi Scheme in France in the 1720s, the South Sea Bubble in Britain in 1720, the railway manias of the 1840s, the Florida land boom of the 1920s, the dot-com bubble of the late 1990s, the housing bubble of the 2000s, the cryptocurrency boom of the late 2010s. Each of these episodes looked different on the surface. Different assets, different financial instruments, different geographies, different historical contexts, but each shared the core elements of the Tulip Mania. Real value in the underlying asset, speculation that pushed prices far beyond any rational assessment of that value, leverage that amplified both gains and losses, social proof that drew in new participants, and a reversal that was faster and more complete than anyone expected. The question each generation asks itself, why couldn't those people see what was obvious, is the same question each future generation will ask about the current one. The obvious answer is that from inside a speculative episode, it is not obvious at all. The rising prices feel like confirmation of a thesis, not evidence against it. The people who are not participating look like they are missing out, not like they are being prudent. This is the lesson that Tulip Mania established, and that every subsequent bubble has reconfirmed. Human beings are not reliably rational about prices. The mechanisms that produce bubbles are not failures of intelligence. They are features of normal human psychology applied to markets. Chapter 14. The Final Question. In 1637, a tulip bulb sold in the Netherlands for enough money to buy a large house in Amsterdam. A few months later, the same type of bulb was worth a small fraction of that amount. The people who bought at the peak lost most or all of what they paid. The flowers kept blooming. The most important thing about Tulip Mania is not that people were irrational, though they were. It is not that the market was fraudulent, though some of the participants behaved dishonestly. It is not that tulips are not beautiful. They were and they are. The most important thing is that the pattern of behavior that produced Tulip Mania is hardwired into human psychology. The response to rising asset prices, the attraction of new participants, the social proof, the feeling that missing out is a failure, is not something that can simply be educated away. It appears in every generation. It appears among the sophisticated and the naive, among the wealthy and the modest, among people who have studied financial history and people who have not. Charles Munger once observed that knowing about Tulip Mania does not prevent you from participating in a modern equivalent. The knowledge is not inoculation. The psychological mechanisms are too strong. What knowing about Tulip Mania can do is create a small space of hesitation. A moment when you ask yourself, is what I am watching a real change in value, or is it a change in what people are willing to pay? The two things are not the same. They can look identical from inside a rising market. The tulips are still beautiful. The Semper Augustus is still gone. The lesson is still unlearned. Remember, this is for educational and informational purposes only and does not constitute financial advice.